At its current valuation, the Wall Street Journal reported that it's actually Best Buy's shares and not their cheap electronics that is the Black Friday deal heading into the holiday season this year. And I'm not so sure about that. Let's dig into it. You're watching More Money? Let's get it. Now, without wasting any of your time, the gist of the Wall Street Journal article, which I'll link in the description below, is that subsequent to the sell-off in the share price of Best Buy that occurred after the company reported the recent quarterly earnings, where the company is now trading at approximately 13 times forward earnings, which for a business that lacks any serious omni-channel pure play electronics competitor is quite cheap, especially considering the greater appeal the brand should get with its new Amazon Prime-like membership program, which should appeal to both its heavy tech users as well as its regular customers who need tech support. Now, I don't disagree that Best Buy looks cheap right now, but what the article is neglecting to mention is that the reason why the stock cratered is because management expects promotionality to increase in the next year as supply constraints ease up. And without any guidance for next year, you can see that I'm modeling their operating profit margin to decline from the elevated levels in 2020 and 2021 back to their 2011 to 2019 average of around 4.5%. On this channel, I don't believe in paywalls, so go ahead and grab that model for free in the description below. Just do me a favor and smash that like button just as a thank you for the model. So when you forecast that lower operating profit margin down to the bottom line, I'm forecasting around $7.50 a share for their next year's earnings. Now, slap a 15 times multiple on the forward earnings and add in the $9 a share of cash, and you have a valuation of around $121 per share. So personally, I don't see much upside at all here. I wouldn't touch Best Buy unless it was selling for around $80 a share, in my opinion. And for the more curious, I'm using a 15 times multiple in my valuation because I don't think this business should be commanding a higher multiple until after I see what they have in store for future growth in their Investor Day presentation, which they're expecting to put on in the spring. And I'm sorry if this sounds rude, but I'm just not convinced that home nesting products, a shift into e-bikes, and potentially resilient appliance sales will get them to command a higher valuation. So, is this a Black Friday deal as the Wall Street Journal is reporting? It looks more like a Black Friday dud, at least right now. And to be honest, I think their cost pressures are being understated because the inflationary pressures are even coming from overseas, such as China. And speaking of which, we have another problem bubbling up to the surface. The real estate market in China is under some serious pressure due to the impending collapse of Evergrande, a large Chinese property developer. I'm currently releasing a 4-part series which is investigating the potential of a Chinese real estate market collapse. To be taken to the first video of this extremely important series, please click right here. Thank you very much, guys, and I'll see you later.